Oh, okay. Look, thanks for having me. I guess first time somebody asked me to do this presentation and sort of said, "Can you please, talk to inflation?" It's obviously, probably topic du jour in economics and financial markets at the moment, but it's also quite a good place to start in that it sort of covers off, kind of where we've come from, sort of where we are, and sort of where we're going. So it's quite a good lens to sort of look at the global and local economy through at the moment. And the discussion so much is not so much in financial markets whether inflation is coming. The reality is it's here. We're at levels we haven't seen for a long, long time. And the discussion really is about how much of it will be proved temporary and how much will persist. And those things are mutually exclusive because if temporary factors continue to persist for a period of time, inflation can become self-fulfilling. It can become embedded in price expectations, embedded in wage expectations. Obviously you get an inflationary spiral. Costs go up, businesses have pricing power, it gets passed on to prices, wages go higher. And look, you can understand, when you look at these charts, why it's such a significant topic at the moment. That chart on the left there, what we really care about is that black line, that is underlying inflation or core inflation, taking out the noise of things like energy prices. And you can see that black line spike to a level that we haven't really seen since 1989, 1990. And that peak that we sort of saw back in 2010, that includes an increase in GST from 12.5% to 15%. So you take that out and you can see we've got nowhere close to that black line in recent history. And what's important for New Zealand is not only are we importing inflation, so there is we're seeing significant inflation around the world. We're also seeing inflation in the local economy. So that chart on the right there, the black line is tradable inflation. The brown line is non-tradable inflation. You can see the tradable inflation, which includes things like imports, energy prices affected by the currency, tends to be more volatile. But that black line, which is tradable and non-tradable inflation, that's what reflects really the imbalances in the local economy, and that's really what the Reserve Bank is really worried about. So that's the inflationary picture. It is more acute than we've seen in a long period of time. As I said, we are importing inflation. We're a small trading nation connected into the global economy, and therefore events in the global economy do impact us quite significantly. Before jumping into it, and look, I apologise for anybody who's done fifth form economics. Just a reminder of what typically drives prices. It is demand and supply. Demand goes up if supply can't respond, then prices typically rise. And if supply falls, then prices typically rise. Now, this can happen in the short term, or it can happen in the longer term, and often it is a short-term factor when demand increases and it takes a while for supply to catch up, or you have some constraints on supply which alleviate over time. But it's just worth bearing that in mind as we sort of run through the various factors that are impacting at the moment. But as a starting point, look, if you think back to sort of February, March last year, COVID hit. It was clearly a unforeseen event, first global pandemic in over 100 years. And understandably, there was a huge amount of uncertainty around the global economy. And the expectations or the forecasts of economic activity were pretty dire. People were talking about significant recession, if not another quite significant depression. You'll recall forecasts of New Zealand housing market falling 15%. But as you all know, sitting here today, the world is much better than pretty much everybody expected. And the reason for that has really been the huge response from policymakers, from central banks and from governments. So Back in February, March last year, first of all, you had interest rates around the world effectively cut to zero in most countries. And then central banks put their foot down on what's called quantitative easing, which is effectively digitally printing money. So the way they do that is they digitally print money and they buy government bonds, and that pumps that money into the money supply. And QE, or quantitative easing, it was really invented by the Japanese back in sort of the 2000s, and it was sort of thought of as a bit crazy and wacky, but became really a mainstream tool after the global financial crisis. And that chart on the right there, that is the US government debt owned by the US Federal Reserve, the US central bank. So that's essentially how much money they have printed. So you can see that after the global financial crisis, they did a bit through to sort of 2014. Hadn't done much, for 5 years or so, but really since March last year have put the foot down, printing more than $3 trillion US. So huge sums of money. And New Zealand, for the first time ever, has undertaken quantitative easing by printing money and buying our government debt. So that was the first sort of intervention by policymakers, very significant reaction by central banks, and that was followed by very significant reaction by governments. And so that chart on the left there, the black bars are the total fiscal stimulus so far committed to combat COVID versus the grey bars, which is the total fiscal stimulus committed during the entire global financial crisis. So you can see that most governments have committed in the order of sort of 4 to 6 times the total fiscal stimulus to combat COVID as they did during the entire GFC. And once again, our government's joined that party. That chart on the right, that's our government debt to GDP. And you can see that from 2008, we were envy of the world. Government debt to GDP are only 5%. And we navigated 2 crises. We navigated the Canterbury earthquakes, and we navigated the GFC, and our government debt rose from 5 to 25. Well, we're forecasting that COVID will take our government debt from around about 20 to around about 50. So it'll go up by 1.5 times what it went up to navigate those 2 prior crises combined. So the way to think about this is you've got central banks around the world digitally creating money, digitally printing money, and passing it to governments by buying their debt, and those governments injecting that money into the economy. And so it's that huge injection of money from governments via central banks that's meant that the world has been much, much better than what people thought. And you can see that here. I've just chosen retail sales, an obvious measure. You can see back in the sort of second quarter of last year, it plunged both in New Zealand and the US. In New Zealand, bounced back, or both places bounced back very strongly, but New Zealand very quickly, well above pre-COVID levels, and only has come back slightly below the sort of pre-COVID trend, but still above pre-COVID levels in the third quarter with lockdowns that you've seen in Auckland and obviously in the Waikato. So retail sales have been booming in New Zealand. In the US, not quite as strong a boom, but helped by stimulus checks being sent out to most people in society 3 times now. Most households have got around about $12,000 given them by the government, printed by the central bank, passed through the government. And you can see that demand's bounced back to that pre-COVID trend. So that's the demand side. Back to that demand supply chart. This is the demand side. It's bounced back pretty quickly, and in the case of New Zealand, it's bounced back to pre-COVID, above pre-COVID trends. What's important to understand, though, is that that bounce back hasn't been even. If you look at that chart on the right, that's US retail sales. You can see that durable goods are things, pretty much anything that's sort of furniture, appliances that sits around your house, cars, exercise equipment, have bounced back a long way above where they were pre-COVID. Durable goods, which includes pretty much anything you buy at a supermarket, but also things like clothes and toys, which are pretty durable, bounced back. It's still above pre-COVID trend. services, things like going to the doctor, the dentist, going on traveling, going to get your haircut, they're sitting a long way below pre-COVID levels. So whilst you've had globally this bounce back in spending, the mix has changed quite considerably. People buying a lot more goods and buying less services. In New Zealand, you're sort of seeing that. People are buying a lot more durable goods. Again, things like, you'll know that, or many of you may know that it's difficult to get a car or a boat or a bike at the moment. But we're still buying pretty much the same services and non-durable goods as we were pre-COVID. So we're spending more than pre-COVID. The rest of the world's spending the same, but just the mix is different. And so really, that increased purchases of durable goods. If you think about what durable goods are, they're typically manufactured. A haircut isn't manufactured. They're typically manufactured, often in low-cost countries, and then they're shipped. And so you all be probably aware of the major congestion out there in global supply chains, in global shipping, the inability to get goods to market. Part of that's due to COVID. Part of that's due to ports not operating at full capacity, factories having been closed. But a huge portion of it is the fact that global supply chains are difficult to scale. If you think about software, very easy to scale, you copy and paste, but very difficult to scale global supply chains. And that schematic there is all the container ships that are currently parked off the coast of North America's west coast. And so what does that mean? That congestion in global supply chains, it's flowed through to this huge surge in shipping rates. So the chart on the right there is shipping rates. The black line is containers. That's what we care most about in New Zealand. Most of our goods are shipped by containers. The brown line is for dry goods, dry bulk goods like coal or iron ore or grain. And you can see both have surged, they've come off a bit. Dry goods have come off a bit more. But at their peak, we're sitting at about 8 times what they were pre-COVID. And even now, still sitting at, sort of 7 times pre-COVID. So, huge surge in shipping costs. And as you know, we are a small trading nation. We're sitting a long way from most of our trading partners, and therefore those freight costs even impact more on us than they do, most countries around the world. I think used cars is probably a really good example of how these supply chain impacts can sort of flow through the broader economy. So if you've been reading any sort of financial media, you'll appreciate there is a global semiconductor or computer chip shortage. And really, the starting reason for that is that actually in 2019, demand for semiconductors was actually easing a bit. Then COVID hit and everybody had these dire predictions about the economy. So if anything, chip manufacturers pulled back on investment. But as it's turned out, demand has massively surprised on the upside. And a big portion of that is people are buying more durable goods, more TVs, more cell phones, more computers. So instead of a contraction in demand, you've seen a surge in demand. One industry particularly impacted by that has been new cars. New cars is impacted because in every new car, there's about 1,400 chips now. But back in March, April last year, people thought nobody would be buying new cars. And what they did think they would be buying is computers and appliances because they're stuck at home. So one, they had a shortage of capacity, but the part of the capacity they had, they reallocated from car chips to appliances chips. Now, today, demand is booming for cars. One, because economies are reopening, but two, because people don't want to take public transport. Public transport usage is well down from below pre-COVID levels. So you're seeing the surge in demand for cars, but we can't produce any new cars. So we're seeing increased demand for used cars. And you can see the last headline there that finds its way into New Zealand with car prices pushing up on Trade Me. And you can see there that chart on the right, that's US inflation. Your used car prices are around about 35–40% above where they were pre-COVID. Just to sum it up, this is US inflation. We use a lot of US data because they have good data, but you can see, those are your inflation trends. Services, pretty much on trend, slightly above where it was. Durable goods, pretty flat pre-COVID, a bit of a spike this year. But the big move has been durable goods. Durable goods typically had been deflationary pre-COVID, benefiting from things like manufacturing in low-cost countries. But you can see really starting at the beginning of last year, but particularly this year, durable goods prices have surged. So really it's that additional demand for durable goods compounded by increased shipping costs, compounded by semiconductor shortages, which has been the biggest driver of global inflation. And those things are also flowing through to shortages in pretty much all durable goods, whether it's bikes, Christmas trees, tires, toys, appliances, furniture. And of course, when there's shortages, businesses have to compete less for your business, and therefore they price higher and they discount less. So those are the major factors, really, that have driven global inflation. But in recent time, it's all been compounded by this, what was an unintended pun initially, this energy perfect storm. So you've had wind shortages in Europe, which has reduced wind generation. You've had dry conditions in North and South America, which has reduced hydro generation. You've had floods in China, which has reduced coal production. At the same time, you've had more extreme temperatures in Europe, which has pushed up energy demand. But because you haven't had those other sources available, people have been turning and using more gas. That's drawn down gas inventories, and now people are pushing to use more oil. And so that's pushed up the oil price, and that's found its way into New Zealand as well. So those are really the global factors. When you run through them, you can sort of understand why the debate is how much of these things are temporary and how much of them are permanent. You can understand why global central banks are sort of sitting on their hands, waiting patiently to see how temporary or permanent they will be. And you're already seeing signs that some of those things are easing. As economies reopen, people are going back to spending a bit more on services and less on goods. And look, there's only so many goods you can buy. There's only so many new sofas and new flat screen TVs that you need. And you can see that freight costs have started to ease, and people buying less goods will ease pressure on global supply chains. And you can see also that the energy prices have come off their peaks. So you can understand, as I said, why some people are debating why the labour more temporary offshore. The challenge in New Zealand is that, yes, we're importing those global factors, but more worryingly, we're also really growing our own inflationary pressures as well. And really a lot of that comes back to New Zealand's migration over the last decade. So that chart on the left there, that is migration, net migration into New Zealand. Sort of three takeaways. One, it's volatile, moves up and down quite considerably. Two, really from being an exporter of people in 2012, where John Key was sitting in Eden Park campaigning, saying, look, this is how many people are leaving New Zealand. You've seen the surge in migration, and particularly in the sort of period pre-COVID, 2019, early 2020, unprecedented levels of migration, only then for it to plunge back down to zero once the doors were shut early last year. And you can see from that chart on the right there, that's population growth pre-COVID, and that's New Zealand right at the top, amongst the highest population growth countries in the world. Australia and Canada, another two high population growth, but still below us. And we're sort of three times what we'd see as our normal peer group, the OECD. So population growth has been a huge factor in New Zealand pre-COVID. And just to highlight how significant it has been in terms of driving our economy. This chart, it's a bit colourful, sorry, but it sort of breaks down the drivers of economic growth into New Zealand into the green bars, that's productivity growth, good growth. The brown bars, that's us working harder, or the sort of grey bars, which are population growth. So, if you look at the sort of mid-2000s, the majority of our growth came from productivity growth, from good growth. We worked a bit harder, and then we sort of topped it up by importing people. But if you look at that last bar, which is the 3 years to the end of 2019, very little of our growth had come from productivity growth. We worked a bit harder, but the vast majority of our growth in recent time has come from that population growth. And we already work the second most hours in the OECD after Mexico, so we don't really want to work too much harder. And that's really the good side of growth, or population growth, as it does boost demand for your end products. It also boosts demand for new productive capacity to produce more end products. So that's the good side of migration. But there's a cost, and that cost is that where supply is sticky and can't respond quickly, you get shortages. And so think back to that demand supply curve. And the most notable one is housing, where our house supply hasn't been able to keep pace with that huge surge in demand. But we also pay the price through traffic congestion, pressure on our infrastructure, health system, education, etc. So what's been the New Zealand economic solution to that? Well, until now, it's been more migration. So the reason I call it the Ponzi economy is really we've been bringing in more people to build the houses and the roads for the last group of people that we brought in. But COVID has really shut the door on that. And so now what we've got is this demand that's been built up by the surge in migration pre-COVID, but without the circuit breaker of bringing in more people to keep a lid on wages and expand our productive capacity to meet that demand. And really, I think the housing market is the most obvious example of that, but it's just one example. If we had sort of no migration, then the maximum we require is about 12 or 13,000 houses a year. It's probably actually not that many, because our population growth probably wouldn't even be 0.6%, because the new migrants typically are younger and add to our birth rates. But take that as an example. No population growth, maybe it's 12 or 13,000 houses. But with the population growth that we had pre-COVID, we actually need 4 times as many of that as that. We need 43 to 47,000 houses. So our population growth is about 1.5% higher, or our population is about 1.5% higher, but we need to produce 4 times as many houses. So, huge difference in the amount of output you need for not many more people. And you can see that, we just haven't kept pace with that. Most places around the developed world, people per house is falling. It's falling like that bottom line in the US. It's actually falling a bit more quickly than that. The US is worried about undersupply in their market, and it's falling for a bunch of demographic reasons: aging population, smaller family sizes, high divorce rates. You can see in Australia, even with their high population growth, they've managed to keep it stable. We haven't. People per house in New Zealand has been rising steadily since about 2008 until recently, where it started to come off. And what happens when demand exceeds supply? Prices go up. And so that's house prices dating back to 2012, just after the GFC. You can see, they're up in most countries around the world, or most countries we consider peer group, but New Zealand, right at the head of the pack. And it doesn't really matter what countries I add. I looked at Hong Kong, which is renowned as being an extremely overvalued market, but it's pretty similar to the US. Germany is or Europe's most major European countries are similar as well. So New Zealand prices, right at the top of the tree. The good news is we've started to make a little bit of a dent in that undersupply with the doors shut to migration, but you can see it's a long way to get down to where sort of our peer group sits. And so that, that high demand is pressuring the labour market. Unemployment rate 3.4%, the lowest on record. The only time it's been comparable was in 2007. But back then, the participation rate, number of people who are available to work, was around about 68%. Today, it's approaching 72%. So if we had the same participation rate as we did back in 2007, then our unemployment would be about 0.5%. And there's a few too many lines on that chart, but I just threw on that blue line there, which is the number of people employed in construction. So you can see that actually it's the highest on record. It doesn't go back that far, but there are more people, higher percentage of the workforce employed in construction at the moment than we ever had, but we've still got shortages, trying to keep up with that pent-up demand. And the chart on the right just highlights the employment rate, the number of people working. And you can see, we're right up there at the top of the developed world. So what does that all mean? It means we're going to see the first meaningful rate hike cycle in nearly a decade and a half. You can see that chart on the left there. That is the OCR, the RBNZ cash rate. They have hiked twice already, so we've gone from 0.25 to 0.75. The market is pricing by the end of next year will be somewhere in the twos. 2.3 is a number that the market is pricing, and you can see, looking back on that chart, that is the first meaningful rate hike that we've seen since really the hikes that ended in 2007. We had a bit of a blip in 2010 and 2014, but they weren't very significant hikes, and they reversed pretty quickly. And you can see from the chart on the right that whilst cash rates are expected to go up across most countries in the world, certainly the market is expecting us to lead the way. So that's what market is pricing. I think it's not a bad starting expectation, but I think you do have to recognise that the world is a pretty uncertain place and can change very quickly. And so it wouldn't surprise me at some point towards the end of next year, the Reserve Bank does sort of start to sit on their hands. And just to highlight, a few of the uncertainties as we look around the world, obviously, not least is COVID. And we've been reminded of that in recent time with the Omicron variant emerging. It is a virus that we will continue to see new variants over time. And when you've got low vaccination rates in places like Africa and South America, then it does have fruitful grounds for newer variants to re-emerge. But outside of that, there are questions about how economies will reopen, including our own. How will people and businesses behave once the virus starts to spread throughout the country? But even outside of COVID, there are still quite a few uncertainties. How will our indebted households and overinflated house prices respond to rising mortgage rates, which are already up quite sharply? And as I said, the first meaningful rate hike in nearly 15 years. We talked before about how significant governments have been in supporting economies around the world. Questions about how willing governments will be to continue to run deficits. How quickly will supply chains adjust? We spoke before about how significant migration is or has been to the New Zealand economy. So questions about when will our doors reopen to tourists and migrants, and then to what extent will migrants return to New Zealand? And then there's some global risks as well, not least China, which is our largest global trading partner, whose property market does look significantly imbalanced with overinflated prices and excess inventory. And so questions around what the outlook for China is from here. Just some last thoughts. I do think there's a few notable vulnerabilities in New Zealand. I think the consumer is vulnerable. Most countries around the world, what you've seen has been consumer balance sheets improve, saving rates go up during COVID, helped in part by government stimulus payments. We've been the opposite. You think back to that retail spending chart. We've been spending well above pre-COVID levels, and that's been funded by debt. So that chart on the left there, that's household debt versus income. you can see it's been pretty flat, really with a bit of a blip during the GFC. But in recent time, particularly this year, that spiked higher, and that chart actually only goes out to June, so I'm sure it spiked higher again through the third quarter. And most of that debt is pretty short term. So over 70% of mortgages are less than 1 year fixed, and nearly 90% are less than 2 year. And that's only started to go up a little bit in recent time as rates have gone higher. So those mortgage rates will flow through to impacting borrowers pretty quickly. I think our housing market looks pretty exposed. That chart on the left there, that black line is the average household on the average income buying the average house, and what share of their mortgage, or what share of their income would it take to service that mortgage. And you can see it's been pretty flat since 2008. And actually, if you take it back further, it's been relatively flat apart from that spike in the mid-2000s since the late 80s. And so what's happened is that as that brown line, mortgage rates has gone lower, house prices have gone up, and the share of wallet the mortgage consumed has stayed pretty flat. But what you can see with the most recent spike in mortgage rates, that equation has changed, and all of a sudden it's gone from representing about 30% of income to 40%. So I think affordability with that spike in mortgage rates is going to start to bite. The chart on the left there is the required deposit, which you can see is record levels relative to income. And a couple of charts I don't have. You are starting to see, you have seen, as we saw before, supply actually exceed demand for the first time in a long time. And just last month, the inventory levels started to tick up a bit. So something I'm watching quite closely in the new year is housing inventory levels. I think the tourism industry looks very vulnerable to me. Obviously, the gates are shut at the moment, but people are talking about a bounce back pretty quickly. It took 6 years, for tourism spend in New Zealand to get back to pre-GFC levels. And obviously, the GFC had nothing to do with travel and borders, and COVID has everything to do with travel and borders. I would be surprised to see tourism spend get back to New Zealand, get back to pre-COVID levels for at least a decade. So I don't think the tourism industry is going to recover quickly. And then just lastly, it's going to be interesting to see what happens, once the Auckland borders open and people start to become more mobile around the country. At that point, you would expect to see the virus start to spread. And we just don't have a lot of capacity in our healthcare system. Where our ICU was already operating at around about 85, 90% pre-COVID. So we don't have a lot of buffer, to deal with COVID if it does start to spread, more widely. So, one of the reasons why, our government's pretty cautious and probably will be, if it does start to spread, and obviously that'll impact on consumer behaviour as well. So that's the end of my, prepared thoughts, but I'm happy to discuss anything you want, really.
Well, Matt, that was a lot of information, but great information. I'm pretty sure that there will be some questions. So if anybody want to make a question, just go ahead with it. Or if not, just raise your hand and I will try to see. Ashlyn?
I was just going to say that sounded pretty depressing. Is there anything good about it?
I don't think it's not meant to be depressing. I think the reality is there's a lot of uncertainty around the global economy at the moment, and everybody got it wrong 12 months ago, and I think you've got to recognise there's quite a broad range of outcomes in the years ahead, and obviously the virus has a significant implication, and will have some significant implications, but so will policymakers. I think we've also got to recognise that the quality of growth in New Zealand in the last particularly 7 or 8 years, has been pretty poor quality. It's been driven by importing people. It's put pressure on our housing market. It's been put pressure on our infrastructure. And then more latterly, it's been driven by consumers maxing out their credit cards, right? And that can continue. We can open the borders again and let more people in. And we could keep rates low, or consumers could keep spending. But the reality is, eventually there's a price to be paid for that. So I think the honest answer is, look, it's not all doom and gloom. Commodity prices are pretty buoyant. Commodities will reopen, but we are going to have to pay the price for some of those non-sustainable benefits that we've had in recent years. And we've got some choices. We can navigate, though. We can rebalance those slowly. We can rebalance them rapidly. And rapidly is not 6 months, though. It's a number of years. So yeah, look, I do think there's a few challenges ahead. I don't think it means we fall into some deep depression. I just think it means we've got a grind in front of us for a number of years to work through the imbalances that that are built up locally.
Bruce, and then Adel.
Yeah, thanks, Matt. It's really good. Recently, I was speaking to one of my friends in China, and sort of like I wanted to sort of just double check on something, and that was that China's shut down its manufacturing to about 60%, with 20 provinces only running on 3 days a week in terms of power. So with that, and given the shipping sort of like chart that you put up there, doesn't that mean that we've actually got not just a little crisis, it's going to be a huge crisis?
Yeah, look, so there's a few things in that, right? So one, China's still trying to pursue a zero tolerance policy on COVID, and part of that's political, and part of that is the fact that their own vaccine isn't that good, compared to vaccines that are available in Western countries. So what that means is, when they do get any sort of outbreak, they stamp down on it pretty hard, and that obviously can disrupt manufacturing and supply chains. So that's the first issue. So yes, we're vulnerable to that. Second is, the point you're making is really a short-term factor around energy supply. And so what you've seen is with two things really, is there's been that spike in demand has put pressure on Chinese manufacturers. Two things happened to their coal supply. One, they've had floods and they've shut down some of their internal coal supply. And two, they had tried to reduce imports from Australia, because, as most of you appreciate, Australia and China aren't best friends. And so that's caused a tightness in coal inventories. They're sort of addressing that pretty quickly. One, they're reopening the doors to importing coal. Two, they're reopening some of their poorer, low quality, environmental quality coal mines, which they recently shut. So I think that energy part will probably remedy reasonably quickly, but they will remain vulnerable to COVID lockdowns as long as they maintain the zero tolerance. I think the interesting thing in terms of global supply chains will be what happens in the new year. You've already seen that the peak has come off freight rates. I mean, they're still massively elevated through history. There is a theory, which I think definitely has some basis, which is shortages drive shortages, right? So when people can't get inventory, they tend to order more, to bulk up inventory. And I think that's compounding the constraints already. But there's sort of some talk, in some sectors, which is saying actually people have got their inventory for Christmas, they've got a bit of a buffer, the urgency is starting to come out of some supply chains. And you've heard anecdotes of that here. You know, I was talking to one of the major banks the other day, and they were saying how, you know, all their building customers are carrying a lot more inventory than normal. Normally they work on a just-in-time basis, but at the moment, because of supply chain issues, they're carrying more. But of course, to fund it, they're having to go to the bank to ask for credit lines. So I think there's some truth to that. So it'll be quite interesting, I think, you know, once we've got through the Christmas rush, the Christmas urgency, you know, just how much they alleviate in the new year. But I don't think it's going to, you know, probably won't alleviate Christmas quickly. It'll probably be, you know, a bit of a slow unwind. But, you know, again, it's one of those really significant uncertainties that sits out there. But, you know, hopefully we do see some alleviation, you know, come January, February, March.
Aidan, you have to unmute, mate.
So my question is really, what is your assessment of the New Zealand government reaction on the outcome of inflation and other performance in our economy? So, and also if you want to split it into, you know, because in my own opinion, there was initial reaction and then the continued reaction, taking, for example, the last 18 months or 2 years in consideration, there was different reaction, and how that impacted in the final result, what we see, you know, in the charts and the information you've given us.
Yeah, look, I think you can sit there in retrospect and say, you know, most governments globally probably can be accused of overstimulating, you know, whether it's from the government itself, you know, or from central banks. The reality is, though, you know, it's the first global pandemic in, you know, over 100 years, and you know, these sort of policies haven't been tried before, and a lot of uncertainty about how it's going to play out. So you can kind of forgive policymakers for sort of overreacting. You know, I think, you know, where we sit today, you know, is our policymakers have got two choices. You know, we've got the Reserve Bank, who manages monetary policy, and they are tightening, and they're forced to tighten because, you know, really because of the built-up demand and supply imbalances in the domestic economy. A lot of the global peers are sitting there and saying, look, you know, we're prepared to wait to see how these things normalize in the new year, but because of those imbalances domestically, we can't afford to wait. I think what they'll be hoping is that, given how, you know, how leveraged consumers are, and given that a lot of that debt is short term, that they might not have to hike as far as the market is pricing. That if you shot across the bow of the consumer will say, hey, look, you know, okay, I get it. I'll just put the credit card away for a little bit, and they won't have to kind of push it as hard. But again, you know, really we'll probably not know that until sort of middle or third quarter of next year. So that's you know, that's I think the key, you know, key economic decision coming out of the Reserve Bank. Yeah, obviously government deals with a whole lot, a whole lot more nuanced in terms of their policy settings about how they impact, the economy. But, you know, I'll come back to what I think is the big one, which is migration. You know, like governments struggle to turn off migration because when they do, it impacts the economy, and they're in a 3-year election cycle, and nobody wants to be the government that tank the economy. And as you remember, 2 elections ago, both Labor and New Zealand First campaigned on reducing migration, but then did nothing. What COVID does, it provides us a reset opportunity. You know, it provides us a reset opportunity to say, okay, you know, what is the right level of migration, and what are the right migration policy settings? And, you know, all around the world, you know, most countries, markets are struggling with bad demographics. You know, pretty much the only area that isn't struggling with bad demographics is Africa. What I mean by bad demographics is falling birth rates, slowing population growth, aging societies. But if you're Europe, you know, it's very difficult to address that, because the only way you grow your population is by opening the borders to the Middle East or Africa, which brings a whole lot of social issues with it. You know, as a small country, we have the we have the chance to make migration a real strength by bringing in the right, the people who bring the skills that we need to grow the pie. But we need to do it on a sustainable basis. And part of that, is being able to build infrastructure ahead of time rather than after the fact, giving our housing market the ability to keep pace with demand. So I think that's going to be the biggest influence over the medium to longer term about what impacts the economy. Obviously, there's other stuff as well by promoting the right investment, but I think that stuff's all really round the margin compared to that big question.
Good. Thank you. Stephen, you have a question?
Thank you, Alfredo, and thank you, Matt, for the presentation and boiling down the situation where we are at the moment to those key issues you identified. Most of the people on the call this evening are owners of small to medium-sized businesses. So I just wondered, what have you seen happen to equity values during the COVID period? And we'll take that as a very poor proxy for the value of small businesses. And what do you think the effect of rising interest rates will have on equity values over the next 2 to 3 years?
Yep, look, it's a good question. Look, the reality is low interest rates have pushed up the valuations of pretty much all assets, whether it's equity or property being the main two. And you can see that to varying degrees, around pretty much all markets. And New Zealand share market, New Zealand property markets are a case in point. I think the reality is higher interest rates are a headwind for valuations, but you've got to put it in perspective. You've seen this long-term structural decline in interest rates, arguably for 40 years, and we hit all-time lows. The lowest interest rates in human history during COVID. And now what we're doing is we're coming up a bit from the lowest interest rates in human history to being, what are still going to be, quite low rates relative to history, but just off the crisis settings that we're seeing currently. And so, yep, that'll be a headwind, but you just got to put it in context. I think you still justify higher valuations in most assets than what you've seen historically, because rates will be lower than than what you have seen historically, just not in the last 18 months.
Thank you.
All right. Any other questions? Peter, and then Bruce.
Yeah, Matt, with regard to the OCR, New Zealand and Canada, are quite a lot higher than, say, Australia and US. So what are some of the similarities or differences between, there's quite diverse economies, like Canada's so much larger, but its interest rates or the OCR's gone up, and Australia and US are quite low.
Yeah, so there's a few things involved. One is sort of our central bank philosophy. Is the central bank prepared to be a bit more back foot or front foot? But the biggest part is that those internal inflationary pressures. How much of it is localized versus those international factors. And Canada's a bit like us. They've had a surge in migration, putting pressure on their internal housing market as well. So they've got some of the same challenges that we do. The UK, which you might have seen, is also going up. That's a bit different. They've got Brexit, and so what Brexit's done is obviously one, put tightness on their labour market, and two, put tariffs on a bunch of their goods that come across the channel. So they've got kind of unique issues. Australia, yes, they've been a high migration market as well. The difference between us and them is their high migration has been more stable over a long period of time, and so they've just got their their infrastructure build, their housing build at a much higher cadence than we have. So arguably they haven't met demand, but they've kept pace with demand much better than we have. So they don't have the same degree of acute demand build up that we do. The other factor I think in Australia is they're more levered into Chinese demand than we are. Even though both of us, Australia is the most exposed market to China in the world. Both of us, it's our major trading partner. But when you think about what we export, it's things like food. The volumes don't move as much. Whereas if the Chinese property market slows, then you just don't buy as much iron ore, right? So you get the flow-on effect of both volume and price. So they typically are, a more cyclical economy than we are. So that's a few factors, that drive that differential.
Thank you, Bruce. Yep.
Yeah, my one was about, Stephen sort of made the comment that we work with SME. So, I know that that's my overriding focus on everything. But when you had the graph and we looked at things like durable goods, my mind immediately went to sort of like multinationals. And when I looked at things like the services graph, which is the one that was below the line, I just kept thinking to myself about SMEs like Hospo and smaller electrical companies, et cetera, et cetera. Is that a fair assessment, so that a fair amount of the cash went to the top end of town and the little guys struggled? Because we represent 95% of the volume of people in business, and even in current situation where we're opening up, we're still probably not opening up fully. So we're still like a cafe might only get, say, 80% of what it used to sort of get through the door before. So there just strikes me there are severe challenges at the SME level. Do you read that from the data?
I think it depends, doesn't it, on the industry? Like I think if you look at one thing on New Zealand is that services haven't actually tanked like they have internationally. You've just had the surge in goods, but you haven't had the offsetting decline in services like you've seen. So as a whole, you'd say, well, New Zealand services haven't been as impacted as badly as what you've seen internationally, which is understandable because until recently, New Zealand's kind of been an ex-COVID economy until we had Delta hit, right? So we've been much more open than the rest of the world. But it's very much industry by industry. I'm sitting here in our little Cambridge office, and I know the guy next door in the bike shop's just been booming for 18 months, right? I know that the guy down the still shop is booming. So it very much depends on the industry, right? In New Zealand's at the top end of town, it's not ideal. So yeah, look, anything that involves close personal contact, people moving around, is clearly struggling. And look, you're probably right. The hairdressers, the hospo, that kind of stuff is at the pointy end of that. I guess there's a lot of SMEs in that space. So yes, if you're in those industries, you're hurting. If you're not, a lot of people biting their tongue, right? Because they don't want to tell you how well they've been going. And what's meant to be a tough economy. I know that talking to local accountants across the Waikato, a lot of them have told me that, their clients have never had it better. So yeah, very much industry dependent. But I think the reality is, there are going to be some challenges, right? Challenge one, borrowing costs are going up. Challenge two, labour markets are tight, wages, you're going to see wage pressure. Challenge three, supply chain pressures, managing inventory. So, certainly have some sympathy for those small businesses. It's clearly not an easy environment managing some of those issues.
All right. So, it's already 6:30. So, I would like to give you, thank you for your presentation and answering all those questions. Has been very interesting, and thank you everyone for coming today. I will stop recording and see you next time.
Very good. Thanks for having me.